All right, welcome back after a long hiatus to the Presidio Perspective. I got a new guest with me, Dave Chenet, new member of the Presidio team. We got a great show for you as always to close out this year. I'm ready to close out this year. You ready?
It's been a tough year.
Yeah. All right, well, let's get it going. Welcome, Dave Chenet.
Thank you.
Yeah, man, it's been a long road to get you here. I'm so glad to be sitting across the table with you here at the Presidio Perspective.
Me too.
Yeah. So, well, we should probably introduce everybody. You don't look too different than the rest of the hosts on this show, so you fit right in, right?
I used to have hair, but when I joined the team, I
just all gone.
Wanted to fit in.
It happens here, right? So, well, good. Well, Dave, tell us a little bit about yourself, where you come from, and why you're here.
Absolutely. So, prior to joining Presidio, was the Chief Investment Officer for a New York City area wealth management firm for about 8 years. Firm focused on retirement income, both planning for retirement income and investing for retirement income.
Sounds like a good fit.
So really excited to jump in and be a voice in the investment committee and work with the ops team, the wealth managers, and just round out the bench strength that we have to devote to our clients and the services that we offer.
Yeah, and most importantly, you escaped New York just in the nick of time and got to enjoy an 80-degree Christmas this year.
That was an additional benefit for sure.
Yeah, the joys of Southern California. Well, it's good to have you. You're already bringing a lot to the team, meeting with clients, and so I'm sure they're all glad to have you here. But well, we have a lot. We've been off the air for a little while. We got our new producing manager here, David Buenaventura, on the ones and twos. So, look, we definitely want to talk about the markets today. You know, we can do a quick recap of 2022 if we need to, but more importantly, let's talk about the themes for the year ahead and what investors need to be doing, what our advice is, and what our perspective is on the current situation in the markets in the year ahead. But before we get there, we've had some pretty big legislation changes just roll through yesterday with the Secure Act 2.0 that actually has a lot in it, you know, that impacts a lot of our clients and a lot of the people that, you know, we serve and talk to. So let's get into it. I mean, there's a lot to cover. I mean, what are some of the most, impactful things you saw in this new Secure 2.0 Act?
I think you said it. There are tons of changes in 2.0. Some of the changes are similar to what we saw in 1.0.
When was that?
That was 2019.
Right.
The biggest change in 1.0 was increasing the age of required minimum distributions.
70.5 to 72.
You got it.
Yeah.
This goes further and increases that to 73 starting next year, 2023, and all the way up to 75, which is phased in over the next 10 years.
So if you turn 72 this year, you're still under the requirements to take a distribution.
Correct.
And you're supposed to take it this year, but you have until April 1st, and then you just have to take 2 next year.
Correct.
But so if you're 72 this year, you're still in RMD, or if you would, are already in RMD territory, this doesn't impact you. But if you're 71 or younger, you're now looking at a 73 required minimum distribution date starting next year.
Correct.
And then if you don't turn 75 until 2033, right? And so now we're talking if you're 64, 65 and younger, then your required minimum distribution date is now 75.
Exactly. So continuing to push out that age at which you need to start taking those taxable required distributions from your IRA accounts.
Which is huge for us. I mean, something that we focus on so much for clients is that sweet spot, that window of when you retire and before you reach required minimum distribution age is your Roth conversion heyday. Those are your years when you're in this really low income tax, especially if you have non-retirement accounts after tax money saved that you can use to fund your cash flows in retirement and take that opportunity to pay very little taxes on distributions out of retirement accounts into tax-free Roth accounts. No required minimum distributions on Roth still.
Correct.
So those remain tax-free, no required distributions. They actually cleaned up a little loophole. They had forced required minimum distributions, I think, on Roth 401ks.
Which didn't really make sense.
It didn't. Not that you hold Roth 401ks when you're in RMD territory anyway. It's likely it's made its way to a rollover Roth IRA. But,
Correct.
Okay, so that extends the sweet spot. So, folks doing their Roth conversion plan just got another year, right? And that's pretty impactful. And some of them maybe got another 3 years. So that's huge. What else did we see in this new 2.0?
So I think another big aspect of 2.0 was a slight change to the catch-up contribution limits. Before 2.0, workers aged 50 years or older could make a contribution of an additional $1,000 into their tax-qualified IRA plan.
Right.
Starting next year, that $1,000 contribution will now be indexed for inflation.
Mm-hmm.
So you'll see that $1,000 catch-up contribution increase gradually over time. But the bigger change is a super catch-up contribution, if you will, for those workers aged between 60 and 63.
Right.
Can contribute $10,000 into their IRA plan.
An additional 10,000 or 10,000 total? That's their catch-up amount.
10,000 total.
Wow. That's weird. They just said 60 to 63. I don't know where the math. Somebody was crunching some numbers and they're like, well, we can't go to 64. So this is like right before retirement where you really want to max out savings and you can put an additional $10,000 over and above the elective deferral limits that everybody has in those years.
Exactly.
And then some big changes to how those contributions were made. So one of the things I saw too was that employer contributions before always had to be pre-tax. So if your employer was doing a matching contribution or profit share or whatever, that was always pre-tax money that you were going to have to take out and pay taxes on in retirement. Now, it seems like, at least for the matching contributions, employees can elect to have that go to a Roth account. Is that correct?
Which is a great option, especially for those younger employees, where maybe they want to pay the tax on those contributions in today's dollar at a potentially lower tax rate, and be able to withdraw that in the future at a higher tax rate.
Yeah, so if you're in a low income year, you'd like to defer that into a Roth, right, and pay the tax now. So that's helpful. If you're in a higher income tax bracket, there's some bad news here. So a lot of our a lot of our hopefully employees, but also our clients that are in higher income tax brackets right before they retire have now had some limitations as to what they can do with this extra money, these catch-up contributions, right?
It seems like a way for Congress almost to balance the books, right? Congress knows that they want to be able to support retirees and support their ability to invest for their own retirement.
But they need tax revenue now.
So to your point, those catch-up contributions for workers earning $140,000 or more,
right,
must be Roth. Sorry, $145,000,
right? Yeah. I was looking at that. Okay, so if you're $145,000 or more in earnings, then your catch-up contribution, you're going to have to pay taxes on it at likely a higher marginal tax rate. So not great for planning, but it is what it is. It's the new law. It goes into effect next year. And so now that's going to end up in a Roth.
Mm-hmm.
So
correct.
Maybe not as advantageous if you're in a higher income tax bracket, but that's kind of what it is, and that's what we're going to have to roll with.
Exactly.
Yeah, okay. And then how you invest that money is, you're going to want to make conscious decisions, obviously, having the tax-free growth of that money versus the rest. Another, there's so much here, but we got to cut it at some point. I think there's one more I wanted to touch upon, which I saw you can now have an option with that leftover 529 plan money. So a lot of our clients, they did too good of a job raising their kids, and their kids actually got scholarships, or maybe they decided not to go to college. They started a business, or they did whatever, and you have these 529 plans that everybody told you to get, and so you put all this money away in these tax advantage accounts, so long as it's used for educational purposes. And a lot of times they're overfunded, and so you're here preparing for retirement. You're in the final years of to max out your savings, and maybe the kids are through school, and you have this leftover 529 plan money, and it's like, what do we do with it? Now it looks like we have some options.
Yeah, exactly. This one makes a whole lot of sense, I think. To your point, those beneficiaries who don't use those 529 funds for college expenses can move that into a Roth IRA account. The money went into the 529 on an after-tax basis. So instead of paying a 10% penalty and then contributing to the Roth, you can contribute that without the penalty into your Roth IRA account with some provisions. That contribution has to be within the IRA contribution annual guidelines and can only contribute up to $35,000 lifetime from 529 funds.
Per each beneficiary or per 529 plan?
Per each beneficiary. Right. So I think that's another important point, right? Grandma and grandpa can't pull that money back into their own accounts without paying the penalty.
Yeah.
But the beneficiary, the younger person most likely who that was ultimately designed for, will be able to use those funds for his or her future retirement income if they don't need them for college.
Yeah, if I have $35,000 in a 529 plan, though, I'm like, can I give that to my kids, or do I pay the $3,500 and just take the $31,500 back to my pocket?
Yep.
I don't know. So yeah, interesting. Something for us to research there. I mean, this law just came out yesterday, right? And so we're all kind of getting into it here, but. I know you can change the beneficiaries of 529 plans. So I wonder what provisions they made about that. Can I make myself the beneficiary of 529 and contribute to a Roth? Can I reach that $35,000 maximum with one beneficiary and then change it to another? So some homework for us to do going into the new year on some of these tax planning changes for the Secure 2.0 Act.
Good to have options, though.
Yeah, absolutely. Well, good. Some more to come on that in future podcast episodes, and there's a whole lot more to cover. So. All right. Well, 2022, as far as investing was concerned, was pretty brutal. It was a year that was not fun. It didn't seem to matter where you were, unless you were in cash. You saw your investments go down, right? I mean, there's some pockets, obviously, that performed better than others, and essentially the thing that was working the best was doing the worst this year, right? Tech and high growth stocks. All of a sudden, these unloved asset classes like fixed income and value companies, and so
almost the mirror opposite of the post-COVID trade, where all the stay-at-home stocks just went through the roof. Right? We saw those come back to
post-great financial crisis trade. Yep. I mean, it was really going on for 10, 11 years, and then really got accelerated, with all the additional money printing that we did in COVID. I mean, we already had a really low federal funds rate. We were already in stimulus mode, very low interest rates. So housing was soaring, tech was soaring, crypto was soaring, and then we just saw it all kind of start coming back to earth here in 2022. So
I think we knew that we needed to see that stimulus come off the table at some point, and the inflation prints that we saw late last year and certainly into this year with CPI hitting 9% over the summer made that decision to end stimulus much more appropriate.
I mean, in this show during 2022, we said, look, this year is dominated by inflation and interest rates. Essentially the Fed's watching inflation. That's going to dictate Fed policy. That's going to affect the economy and the overall stock market, and it did. We also told investors to be diversified, to not put all your eggs in one basket. Things that work oftentimes are the things that don't work, and review that periodic table of asset classes over and over, talking about the importance of diversification. So going into 2023, are we switching our theme, or what are our themes going into 2023?
So good question. Before I jump into the specific themes, want to add some context a little bit. So what we try to do when we're building portfolios, we're not trying to day trade. We're not trying to pick the next hot stock. And I think it's important to recognize that there's no one perfect solution for every problem, right? I think the first question that we need to ask ourselves as investors is, what problem are we trying to solve for? Are we trying to, hey, we think stock A is going to go through the roof tomorrow, or it's going to tank tomorrow? Or are we trying to be stewards of our investors' capital and position that capital for the best long-term success, whatever that means to each individual client? So with that said, our mandate is first to build really diversified portfolios. So each client has their own specific risk requirement, how much risk they're comfortable taking with their investment dollars. and the purpose for those dollars. Are these dollars intended to support spending that I need in the next 2 or 3 years?
Right.
Or is this money that I'm ultimately going to leave to my children, my grandchildren, that has a 20, 25, 30, or longer year investment horizon?
Well, 9 out of 10 of our clients, I'll tell you right now, don't want to leave it to their grandchildren, right? We want to spend the last check and bounce it to the mortician, right? Or
Absolutely.
bounce the last check to the mortician. So.
Absolutely. But knowing that we're starting from that diversified portfolio,
Yeah.
I think helps put these decisions in context. I think the other really important thing to consider is the investment time frame.
Mm-hmm.
Right? We're long-term investors. We have the ability to, an analogy I like to often use is if this is a 9-inning baseball game and that's the market cycle, we've got the ability to sit out the 8th inning, to sit out the 9th inning if it means that we're a little better protected when that cycle eventually turns around. And then conversely, we're not trying to call the bottom. We know that it's a fool's game to try to perfectly time market tops or market bottoms.
Yeah, and that's what everyone's doing, right?
Yep.
I mean, that's really what you do. And it's good, I think, to have that exercise. I mean, I like to talk about it, and I like to prepare investors for it because we can say, here's the potential drawdown.
Yep.
And you do that, run those numbers all the time. You shared them with me, and hey, based on these different, market hypothesis, of what could happen with interest rates, inflation, war,
Yep.
Demand, and what people think about, multiples on the earnings. What are the earnings going to be? What is the demand for risk? And that's going to give you certain price levels of like the S&P 500, et cetera. So it's good for investors to know, I think, kind of that band, right, of what they're playing with.
Yeah, definitely.
But we don't know. I mean, there's all these there's the known knowns, the known unknowns, and then there's the unknown unknowns, and those things can really shift markets.
Yep.
Right? And so it's like, the known unknown was inflation. And the debate a year ago when we were sitting here, doing this podcast a year ago was there's a big argument that it was all transitory. This is all due to COVID. The world's going to reopen, and you don't want to be too aggressive or too tight on monetary policy.
Mm-hmm.
You can drive us into a deep recession. And everyone's out there, blaming the Fed, saying they need to do more, they need to stop, printing money, they need to be more aggressive with interest rates, and then so that's what they do, and everyone's like, whoa, you shouldn't be so aggressive with interest rates. So it's kind of funny to hear that, dialogue going on. But, so anyway, so here we are, interest rates have shot up, multiples have come down, and we have a lot of opportunity now, though, of what that's provided us looking forward.
Mm-hmm. Definitely. So brings us perfectly into our first key theme, I think. First theme is be different. And this is a philosophy that I espouse in lots of areas of my life. But what I mean in terms of the portfolios is the S&P 500 tends to be the benchmark for a lot of people out there, which there needs to be some benchmark, but is that the best benchmark? So if we dig into the S&P 500 a little bit, it was launched in the late 50s. Think about the computing power that we had in the 50s versus the computing power that we have today. Back in the 50s, they didn't have the ability to be as granular as maybe we could be today. So they went in and built that index as a market cap index.
Right. So essentially, right, they're going to buy more of the companies that are worth more. So you're buying more of, let's just say, the more successful companies. Mm-hmm. That stands to reason with a lot of logic out there. It's like, hey, I want to own more of the most successful companies in the country, or probably on the planet, right? And at the time, though, much better than the weighting index prior to that, which is the Dow Jones Industrial Average, which was based on the stock price.
Purely stock
price. So it didn't encompass, stock splits and, it's just whatever the price of your stock was, mm-hmm. which is outlandish, mm-hmm. determined whether it was going to be weighted more or less in that index, which made no sense and still doesn't. People still follow the Dow. We still do, right? There's all kinds of financial products based on the Dow. Mm-hmm. So the S&P 500, let's say, was a smarter way. I mean, it was probably pretty,
revolutionary.
I wasn't there
at the
but
time.
I'm sure it's pretty revolutionary at the time. So, but yeah, there's different ways to go. So one of the risks I think that you're getting to is when you look at these market cap weighted index, you're buying the companies that are worth the most. But the value of a stock or a company is two things. One, how much is it earning? And two, what is the multiple on those earnings? And the higher multiples are pricier. They are cost you more, right? For that same dollar of revenue or that same dollar of profit, you're paying 20, 30, 40, 50 times in some of these cases when you look at the top 10 of the S&P or the NASDAQ, even worse. I mean, you're paying a really expensive price to get that dollar of profit versus something else that is less valued, but I have to pay a lot less for that dollar of profit. And so that's when you kind of look at growth versus value. And that's a big change that we've seen when you look at this index, because when you concentrate at the top, what you see last year, all growth.
Yeah, I think that's a really important distinction. If we think back to when that index was created in the 50s, it was purely just an index. If you wanted to actually invest in it, you had to go out and purchase 500 stocks and figure out at what weight to hold those.
Right.
But we saw the first actual investable product that tracks that index was in the late 70s from Vanguard.
Right.
Those products have really taken off over the last 3-4 decades. If we think about the three big ETFs, exchange traded funds, offered by Vanguard, offered by iShares, offered by State Street, if you just look at those three ETFs combined that track the S&P 500, they have over $1 trillion in assets.
Mm-hmm.
If you add to that mutual funds that track the S&P 500 and also active managers who are benchmarked to the S&P 500, right, even though they're not perfectly replicating that index,
buying all the same stuff.
Studies have shown that they tend to look really similar to the index.
Mm-hmm.
So combine all of those sources, and we're probably talking in the order of magnitude of $3 to $4 to $5 trillion.
Mm-hmm.
To put that number in context, the GDP of the U.S. is about $23 trillion.
Mm-hmm.
So a really sizable amount of money following the S&P 500 weightings. So it's almost this self-fulfilling prophecy. As certain stocks, certain sectors gain higher market value,
Mm-hmm.
whether that's because their multiple has increased or their earnings have increased,
Mm-hmm.
more money flows into those names. As more money flows into those names, the weighting in the S&P 500 increases, and more money flows into those names. And tends to not be the smartest investment strategy over time. I think we've seen this phenomenon in the last 3 really severe market crashes. Right? Think back to, was it 99, 2000,
Mm-hmm.
the dot-com stocks. Those dot-com stocks represented about 30% of the S&P 500
Wow.
at the peak in 1999. The NASDAQ fell 90% between 2000 and 2002.
Yeah.
In 2002, those same sectors represented about 10% of the index.
Yeah.
See the same thing with financials.
So 30% to 10%. That's interesting, and especially if you kind of look at where we were in '99 versus where we were just coming out of in 2021. There's a lot of parallels.
26% at the end of 2021,
Yeah.
and tech has been the worst performing sector by far so far this year.
Yeah, and that's just technology. That's not communication services and
Correct.
retail like Amazon.
Correct.
Right. Okay.
So a lot of people will
You're
say,
saying financials, what, in 2008?
yeah, another
2007?
similar concept, right?
Yeah.
Financials leading into 07, 08, not quite as high a concentration, but represented 23, 24% of the S&P 500. We know what happened to financials during that crisis.
All that said, if you invest in the S&P 500, right, over long periods of time, you do okay. And you do benefit from having those smaller companies, overtake those bigger companies. And so you do have these things coming down, these things coming up. And so through rebalancing, you're going to do okay.
Mm-hmm.
I think the concern is when you look at a lot of the people that I've consulted with over the last few years have, and so what COVID did, people didn't rush out and buy the S&P 500. Right? You had the boom of crypto, Robinhood trading. Everybody was a trader. Meme stock craze,
Mm-hmm.
right? People are still holding on to that trade,
Mm-hmm.
and so you had Wall Street bets and all this stuff, and the really empowerment of the retail investor, who's gotten brutalized, right? Because they just went in, and if it goes up, it must keep going up, right? And then it goes down. They go, oh, well, I'm long term. Well, then it goes down another 50%. You know, it's like, oh, people weren't going out and buying the S&P 500 in droves. That wasn't good enough. Had they done that, they would have been much better off. They would have been down 15 or 20% versus down 70.
Yep.
Right. And so, you know, when you look through this year, and I just like, oh, I'm so grateful that we're able to, you know, meet some of the clients that we did at the opportune time to have them rebalance, because you had these concentrations and they're still out there where people have all of their money in Tesla. They have all their money in Apple. They have all their money in the most expensive companies. And you just look at, you know, go back a few years. What was everybody talking about? You know, it's MAGA now. What was it before? FANG, right? And
yep.
you're like, you know, how's Facebook doing? How's Netflix doing? Remember, you just bought FANG, Facebook, Apple, Netflix, Google. That was, and there's 2 A's, and then Amazon, right? Mm-hmm. And that was all you needed to buy. Well, what happened? Oh, we had to change the acronym because they didn't work, and you lost 90% of your money in some of these cases.
And what a roller coaster for those smart enough to get in 3 years ago.
Right.
You saw those names go up 50, 60, 70% or more and have given back all of those gains since then.
Yeah.
Right. Buy low, sell high seems like the easiest thing to do in finance, but is often the hardest.
I think the selling high seems to be a lot harder for people. And that's been my experience in doing this almost 20 years and counseling people, is that it's almost impossible to convince somebody that the thing that's just been going up, and I had lots of conversations about Bitcoin, I had lots of conversations with clients for the years about biotech or whatever it is. And here at Tesla, Ford was a similar story going back in 2000, 2005. I mean, Ford, they soared. Their market cap was huge. General Electric was another one. I mean, when you have something that's just worked for decades and decades, and something GE was a century before it didn't. Mm-hmm. It's just really hard for people to rationalize that this won't just keep performing, and they want to put more of their eggs in that basket and not diversify. Mm-hmm. And so when you get concentrations into these things that have been successful, well, that's what you should do, is take those chips off the table and reward yourself by building that diversified portfolio. And so that's where a lot of people didn't do it, unfortunately. But if you're in the S&P 500, look under the hood. If you're in the NASDAQ, look under the hood. And I think that's what we're seeing is being different means don't just buy the most expensive companies. Because if we are going into a recession, which we are, I mean, we'd be hard-pressed to find somebody who says we're not headed into a recession. I mean, all the warning signs are there. Mm-hmm. Every alarm is ringing. All the lights are flashing. Like, look back in history when you've had these things, and you've had rampant inflation, when you've had rampant money printing, then you have a tightening cycle. You have housing turning over. You have jobs, disappearing. You have massive layoffs. You have, the biggest sector of the economy is now in a vicious decline. Like, what are you looking at that's saying that things are going to get rosy here in the future? Now, as investors, we start licking our chops about, oh, this is going to be good because this is when there's opportunity in the stock market. But those expensive companies, I mean, if you take Apple, I think you said it the other day, it's like, it doesn't mean Apple products are bad. Apple products are great, but how much are you going to pay? Maybe a Tesla's a great car, but how much are you going to pay for that stock?
Yep.
And, going back a year ago, it was 100 times earnings. I think it was more than that. Do you know what it was at the high?
120,
120, 115.
Just,
I mean,
astronomical.
For $1, you're paying 100 years of earning that dollar because there's going to be so much growth. And then when you lose 50% of the value of your holding, it's still at 50 times earnings, which is still nosebleed expensive.
The analogy I love to use is most people really like their house, right? Let's imagine that you live in a house that might go for, call it $700,000.
Okay.
Do you like your house?
Yes.
Yeah, you like your house.
Right.
Do you like your house for $10 million?
No.
So it's
I'd rather
hard
the $10
to.
million.
You need to consider price when you consider value, right?
Yeah.
You can't extract price from the value equation.
Right. No, that's a good analogy. So being different means, and so then you look at technology right now. And so if you're saying, tech's been beaten up, and if you kind of look under the hood, and you were showing me this, a couple weeks ago when you were looking at those companies under the hood of the NASDAQ, and in the S&P that are way down on the market cap weighting, right? So when you buy a NASDAQ or an S&P 500 index fund, they're market cap weighted. You're buying most of the expensive companies, and you're buying the least amount of the cheap value companies where you might have a lot more opportunity.
Mm-hmm. Correct.
So a different way to look at weighting an index, right? You talk about revenue weighting, you talk about equal weighting. There's different ways to go and invest in a space to buy more of the companies that are potentially trading at better prices.
Exactly. Just a quick example of that. Apple represents about 6% of the S&P 500 market cap weight.
And it's 12% of the NASDAQ, I believe.
Yeah, exactly. Yeah. So pretty big concentration in both indices. But if you were to revenue weight the S&P 500, so instead of market cap weighting, how much revenue do these companies actually produce relative to the other 499 stocks in that index? Apple would be about 3% of the index. Mm-hmm. So from 6 to 3. Interestingly, Walmart is the number one revenue producing company in the United States.
Yeah.
If you were building a revenue weighted index, Walmart would be your biggest position. In the market cap weighted S&P 500, Walmart's not in the top 5, it's not in the top 10, it's not in the top 25. It's number 33 in that index, with a total weight of 0.6%.
Yeah.
So 1/10 of the weight of Apple.
And not to make any suggestions of like what's going to do better, it's Walmart or Apple, but it's just a different way to look at an index and to have an idea of where your concentrated risks are, right? I mean, that's kind of what we're talking about.
Exactly.
Where's the reward, where's the risk, and understand that and how your portfolio is allocated. I wonder if ExxonMobil's challenging Walmart on that with these gas prices as far as revenue is concerned, right? I mean,
or maybe they will soon.
Yeah. So, all right. So be different. Right? Don't just buy what's worked. We already know that. I think people understand that. And so where's the opportunity? Figure out a way to capture. Don't put all your eggs in one basket. And know that there's a kind of a changing paradigm and a playbook for the future, especially this year. You have interest rates higher. So we'll get to that. All right? So I won't steal it. So be different. And your next one, be disciplined.
Be disciplined. So I think we alluded to it earlier, but late last year, most investors wanted to buy more tech. They wanted to buy more stock. I think there's a natural human tendency to look at the past and use the past as a predictor of the future, when it's almost the exact opposite, right? When things have gone up substantially, that's the point of maximum financial risk. Mm-hmm. When things are at the bottom, that's the point of maximum financial opportunity.
And the least risk.
But the way that we're designed is to do the opposite of that, to be more risk-seeking at the top of that cycle and more risk-averse at the bottom of that cycle.
Yep.
So what have we seen so far this year? We've seen the S&P go into bear market territory to fall 20% or more from its high. Typically, in a bear market, you see the S&P fall between 25 and 35%, depending on whether or not there's a significant economic recession or not. But disciplined investors start to find some opportunities near the bottom of that market. And I think it also goes back to our investment philosophy. We have the ability and the luxury not to try to perfectly time the bottom of the market. But if we think of where prices are today, where some valuations are today, where some opportunities are today, if we purchase at today's prices and look back 12 months from now, 18 months from now, 36 months from now, could very well be in a position where we look back and say, that was a great time to buy.
We talk about that all the time on this show. Shoulda, coulda, wouldas. What are the shoulda, coulda, wouldas I'm saying now about what I wish I did a year ago? Well, nothing I could do. So we always try to think of what are the shoulda, coulda, wouldas I'm going to be saying a year from now, looking back at this point. I think you're right. It's when these markets are down, when you're saying, oh my gosh, here's where all the risk is. That's kind of the risk has happened. If you look back over time, too, go back the last 100 years, track the index, and say how long bear markets last. They're not that long.
No.
I mean, we're talking about 9 months to 2.5 years. 2.5 like is a really bad bear market. And that was like 2000, 2002, and it's because you had 9/11 going on right as you had the tech wreck, right? I mean, there's kind of two forces that drove an extended bear market for some time, and then 2008, of course, was an extended one. So you kind of had those two. But
and we're now 12 months in and have seen that 25% decline.
Yeah, I think we're 13. I think it started November 1 of last year if you look at the index.
Yeah.
And so, you're getting pretty close.
Yeah.
So, do we want to call a bottom, or are we looking out as a long-term investor? And even if you look out 10 years, you're feeling pretty good. But even if you look out 2 or 3, at least historically, it's a pretty good time.
Yeah, exactly.
So being disciplined means, don't, cash out, bail out, or don't go to the one thing that's worked, right? I mean, stay true to your long-term portfolio. I mean, if you have any of these risks that we're talking about, where you're concentrated in individual equities that are expensive on their price, if your portfolio is not diversified, you're going to want to make sure that it is. But it's not time to just panic and get out. This is usually the time to get in. If you do have cash on the sidelines, well, this is the time that you probably want to look at starting to buy at these levels.
When it's kind of hard to do something, that's when you want to do it.
Yeah, and being disciplined, also know that, look, the news is probably going to get worse. We've seen some positive news likely, and, we're back to this good news is bad news is good news thing, but China's reopening.
Mm-hmm.
Okay, so that's been a big overhang, I think, on the global economy for a while.
Mm-hmm.
So we'll see what impacts that has. The Fed has done a lot of its punishment, right, to the economy, and it's starting to have that tone of where you have to let it kind of set in and see the effects. So we know we're kind of almost at the end of, this tightening cycle. We know that the unemployment numbers are starting to mount up. We know that real estate is rolling over.
Mm-hmm.
It's already come down.
Mm-hmm.
Lots of markets are going to see 20 to 25% declines in this next year is what they're saying, right, in real estate, especially the ones that did really well the years before. Mm-hmm. So all of these things make investors nervous. And so being disciplined right now, it's like that might be even more important in the months to come, right? Because right when it's the darkest all around us, that's usually when the market likes to start going up. That's when seasoned investors, institutional investors really turn on their risk trade.
And we all know that the market is forward-looking, right? We started this sell-off before we really started to feel the pain economically, and the same happens in reverse. As soon as we start to bottom economically, that's when the market really starts to take off.
Yeah.
I think a big question mark this year is we all know inflation's slowing, but to what level will it slow? Will we still be in this 5 to 7% inflation environment? Or will inflation return back to a level in which the Federal Reserve is a little bit more comfortable easing financial conditions?
Yeah.
I think we've seen a lot of that inflation start to come out of the numbers that we're seeing, whether it's the PPI, the Producer Price Index, the CPI. A lot of the housing numbers, to your point, are starting to come down. A lot of the commodity numbers have given up.
ISM's still hot, though, right? I mean, it's starting to come down.
Starting to come down. I think we're the leading economic indicators are really showing that a lot of the stimulus, the sugar high, has come out of the economy. Right? I think if we think back to the amount of stimulus that people received post-COVID, it was the only economic recession where disposable income actually went up instead of going down.
Yeah.
Because, people were...
Like a 26% savings rate that year.
Exactly.
You got free money and you couldn't spend it if you wanted to.
So couldn't go on cruises, couldn't go on vacations, couldn't go out to restaurants.
No.
What did people do? They bought goods. They bought golf clubs.
They bought AMC.
Yeah, stocks.
And crypto. Absolutely.
But we're seeing those retail spending numbers kind of come out of the economy. We've seen goods inflation.
I agree. And I think, kind of my theory, looking back over my career, is just, when that housing really starts to roll over, that's when you really see people pull back. And interest rates have shot up. People are going to start to feel the pain of those credit card balances, those home equity lines of credit.
Yep.
And then come the jobs, start going away, and then, it really permeates through the economy.
Yep.
So, but that's really good news for stocks in the future, right, when all that happens. So be different, be disciplined, and you say be balanced.
Be balanced is our third theme. So when we say balance, we mean understand the trade-off between stocks and bonds.
Right.
Because interest rates have been so low really since 2009. We've gone through 4 eras of quantitative easing. The Fed has grown their balance sheet from nothing coming into the 08-09 crisis to over $9 trillion at the end of last year, which has suppressed interest rates. But now we're in an environment where we finally do have some of that inflation, where the Fed balance sheet is starting to come off, where we've seen the Fed increase the Fed funds rate, and fixed income rates have responded. Thinking about
we talk about asset allocation a lot. We're talking about growth versus value, large versus mid versus small, domestic versus international. So asset allocation, right, is something that we talk about, looking at different asset classes. And so this is kind of what I call asset mix. How much cash, how much stocks, and how much bonds do you have? And what we've noticed over our careers, especially over the last 10 years, what did you see? People had all stocks, and if they wanted to decrease their risk, they increased their cash. Even today, as we're seeing, I have lots of meetings every day, and I'm looking at people's portfolios, and they have growth equities and the guaranteed account in their 401ks, right? Or they have cash off to the sidelines. And this fixed income, what are the acronyms you use? What was it? Is TINA versus TERA?
So a long time the acronym was TINA. There is no
alternative, right? And so it didn't make sense. And Susie Orman to Warren Buffett was saying, why would you buy a bond paying 2%?
Yep.
Why would you, right? I mean, why are you paying this 2%? And so what happens is, you're buying something that over the next 10 years is likely to be worth less when you get your money back. It's only paying you 2. However, inflation was 2, so it's kind of like a preservation of capital trade. But they have this inverse relationship to interest rates. Now what you're seeing is there's opportunity because, so what's TERA? There
are reasonable alternatives.
Because, money market funds are hitting 4%.
Yeah.
So cash is also an asset class, right, that we didn't look at because cash was 0. Everybody would come in and say, I'm earning nothing, I need to do something with this, which is just, I'm in cash or I'm in stocks.
Correct.
And like, how could you get any different, right, from an asset class? And so now it's like, okay, I have cash earning 4, right? Now it has a stable price, so it's not going to give you that ballast, right? If stocks sell off and interest rates come down, that fixed income now provides. And fixed income, you're getting those 4, 5, 6% yields on guaranteed investments that pay you your money back at the end of the term of the bond. Especially if it's the federal government. And so you're getting this yield. And then if you think of what happens in recessions, interest rates go down, and that bond price actually has a built-in capital gain likely for you on the other side of this, tightening cycle that we're in.
Yeah, exactly. So now an important part of investor portfolios, which haven't been able to say that for a long time.
Yeah. And so it's, it depends on what kind of fixed income you do, right? But think of mortgages or another, people read these headlines that mortgages are on all-time highs. And I talk about this in our Retirement 101 class. And I liken, buying a home and having a mortgage is exactly like owning stocks or owning bonds, right? If you own the home, that's like owning the shares of the company. That's like the stock, right? You own it. You have to pay all the expenses. You get all the reward. If it goes up in price, you earn the money. If it goes down in price, you lose the money, right? And then you owe money to the bondholders of the bank. And what do they get? Guaranteed principal and interest payments over a term. And if you can't pay them, then guess what? They become the new owners of the home, or they become the new owners of the company. But those bonds and mortgages are securitized, and they trade. You sell them.
Right.
Mortgages are bonds. They're a guaranteed principal and interest over a term. What is a bond? Guaranteed principal and interest over a term. Collateralized, right, by the most precious asset of the American public, their home. People pay their mortgages. Like, they will take on a second or third job to pay the mortgage. They'll borrow from their mom, dad, brother, sister. They'll steal, beg, borrow, sell their coffee table, do whatever, right? We've seen that over and over. The last thing that you do is not pay your mortgage, right? It's a really good credit risk.
And God forbid if people do default, the bank's protected because they have the real asset behind it.
Right. And they keep the credit default swaps these days.
Right.
So anyways, you're reading these headlines, and I see them all the time. I know investors are seeing them. And mortgages are at all-time highs. Well, you can own mortgages in your fixed income portfolio. You get bond managers that invest in mortgages, and when you see a mortgage hit 7%, I could own those mortgages and get paid 7% invested in that asset class. And where would you rather invest in real estate right now? Would you rather go buy the home right now? I don't know. That sounds like a pretty risky trade to me. That sounds like the next domino to drop, right? These mortgages are kind of at the price of the mortgages is down, the yields are up, and once housing rolls over, how do we stimulate housing? Mortgages drop, and those mortgages that are bonds that you own now go up in value.
Right.
We just have to, it's the shoulda, coulda, wouldas. If you see how this plays out, and I think you make a good point, is it important to know the dates of all of these things, when they're going to occur? Is it 1, 2, 3 months? Is it 6 months, 8 months? Or is this just the cycle of what's going to go? And where do you want to be as you go through this cycle? Right? And I think that's more important. If you could just have a little bit longer view into the future. Going back to being disciplined, right?
Right.
And so these are all kind of related, being different. It's like investing in fixed income is different. That's something people haven't done. I mean, there's who talks, there's not shows talking about the bond market, except for this show, except for the Presidio Perspective. Maybe we should launch a whole, a bond show, just to educate investors about the thrills of investing in fixed income.
Absolutely.
Yeah. So being balanced, making sure that, a lot of people are concerned though. They're like, well, I have stocks and, they're down. So you're telling me, Dave, I need to go sell my stocks low and buy bonds, but you said be disciplined and don't sell low. So how do I reconcile those things?
An exercise I love to do is to get rid of that bias, to say, okay, know that you have owned this stock for a long time, but let's imagine that.
But even if I didn't own it a long time and it's down in value,
Yep.
I'm not supposed to sell. Why would I sell and go into fixed income now?
I think imagine your portfolio is 100% in cash. What's your ideal allocation at that point? Will you be based on your individual circumstances? You might be 80% stock, 20% bond. You might be 70% stock, 30% bond. I think it's really important, especially in this environment where, we think there are opportunities on both sides, but also a lot of risks on both sides, to get back to that stock to bond mix, as you described it, the right mix of assets relative to where you are in your investment time life.
That's exactly. I mean, that's the paramount. I mean, that's what's most important. And that this money is just, it's not real. It has a means to an end. You have to do something with it. You get your financial plan. You know what you have to do, and that's going to help dictate your asset classes. The other thing I would like to mention is that, you might be selling low in stocks, but you're buying low on fixed income. Mm-hmm. When you hear that rates are up, remember, there's an inverse relationship. So bond prices have come down. Mm-hmm. So it's actually the best entry point we've seen in fixed income in I don't know how long, right? The 80s? I mean, it's just like when you've seen a decline like this. I mean, the last time the aggregate bond index lost more than 3% in a year, you got to go back 20 years. And it was down 15 this year.
Yeah, and the second consecutive year in which the ag bond index is down, which it's never done before.
Yeah. So good opportunity there if you don't have that. And if you're in cash, I mean, what a great opportunity to reposition that into both stocks and bonds. Cash isn't bad. You want to have the appropriate mix there. Getting paid 3-4% with no risk, that doesn't sound so bad either. You got to go back to mid-2000s the last time we had that.
Again, I think it's understanding the purpose of the investment, right?
Yeah.
Which is where I think we add a ton of value for our clients, is to do the work up front and create the financial plan and know this segment of your assets needs to support your income over the next 5 years. This segment, we've got 10, 15, 20 years or more. So that distinction informs how much volatility you can afford and informs the asset mix for those assets.
That's well said. So closing out the show, I'm going to throw you a curveball. If you can sum up 2023, what are your feelings about 2023 in one word?
Awesome.
Awesome. Yeah, I hope so. I think that's good. I'd say I'm excited. So certainly hope springs eternal. We'll see. But we're always here at the Presidio Perspective, helping you guys sift through all that news out there and see how it pertains to your portfolio. So Dave will be back with us a lot more in the year to come. Hopefully you get to meet him and see all the great things he's doing in our clients' portfolios. Hey man, Happy New Year. Let's send off 2022 and welcome 2023. So Happy New Year to everybody else. Be safe out there, and we'll see you in the new year at the Presidio Perspective.